Good morning, everyone, and welcome to this morning's webinar from a beautiful sunny morning in Wellington. I hope it's sunny where you are too. This morning we're going to cover three topics this morning, three quite distinct topics, but all pretty important in the scheme of things in the not-for-profit sector. My name is Henry McClintock, and I'm the lead in the not-for-profit sector for BDO nationally. And this is part of our Rethink webinar series entitled Governance, Investment and Impact. Look, we've got three great speakers coming up this morning, Carol and Andrew and Bernadette. All three subjects could be a webinar in their own right, but we've asked them just to keep it to sort of 15 minutes each to give you a little teaser and some good value points to take away and that sort of thing. There will be an opportunity at the end to ask questions. You've got a chat function in the that you can use as well to ask questions. So as we're going along, if you have questions, please post those. But we'll come to that at the end of the webinar. So yeah, great to have your attendance. Please get involved. Please listen. Please ask questions. And I'll now introduce our first speaker. So. Our first speaker this morning who's going to talk is Carol Scholes. She's, got 30 years experience in working both in management and board level, and it's all about, effective leadership at the board level. She's a facilitator for the IOD, but also a lot of practical experience herself. Is the chair of Canteen, along with a number of other governance roles. So Carol, hey, look, it's really awesome to have you here this morning. We're really pleased to have you. I'm really looking forward to what you've got to say, and over to you. Yeah.
Thanks a lot, Henry, and good morning, everybody. It's nice to be here. So my topic is to talk about the strategic leadership role of boards. And this is the big hot topic for all boards now. Often we come onto a board because we want to make a difference, but we often find our board meetings end up taking us down management reporting and talking about what's going on in management. But these days, the requirements for boards to really be thinking well ahead and where is the organisation going. It's such a strong requirement. We're seeing it from social media. We want that they expect boards to be thinking, where are we going? We're seeing it from our stakeholders. What are you trying to achieve? How do you know you're going to achieve it? So strategic leadership is the big new hot topic for all boards to have in their meetings and to show leadership in the organisation. So I'm just going to touch on what do I mean by strategic leadership, and then we're going to go through and talk about some of those key things, topics that people are talking about, and then we're going to relate that to risk. So first off, what do I mean by strategic leadership? That's essentially looking forward. So instead of just looking back at what happened in the last few months and looking at what management did and where they spent the money, strategic leadership is really getting focused on where you're going. The first thing you need to be doing as a board is really get clear on your purpose. And this is an interesting conversation. Even in the profit sector, a lot of people think that the purpose of a profit sector, for example, is just to make a whole lot of money. In the not-for-profit sector, we often are trying to do really good in the community. But getting really clear about what our purpose is and the point of difference that we have, this is the most useful conversation that we can have. So I was at the IOD conference a couple of weeks ago, and there was a speaker there from the States talking about how all organisations, whether they are profit or non-for-profit, are talking about purpose. And he gave the example of Novo Nordisk, which is a Danish company who provide 85% of the insulin in the world. And they have always had the purpose of, let's just make a whole lot of money by being the best producer of insulin. But they started to really think that through and thought, what are we actually trying to do? Are we just trying to make money, or are we trying to have a greater good purpose? So when they really looked at it, they decided that their actual purpose was how to avoid people getting type 2 diabetes. When they started using that as their purpose, suddenly a whole lot of stakeholders started to think, hey, we trust you because we see you have a greater purpose other than just lining your pockets. So what has been really interesting with them and with many organisations who've thought about what their greater purpose is they're starting to make money, more money than they ever did when they were just focusing on profit. Now, in the this whole driver to get really clear about your purpose is being driven from example like the ESG, environmental, social and governance, which lately has been repurposed to EESG, meaning that we put employees at the front of it, employees, environment, social and governance. And all organisations are having to start thinking about what is our purpose in the greater community and in what we're trying to do in the world. So clarity of purpose is vitally important. And it is always astounding to me when I talk to boards, how often they just know kind of what they do, but they don't really understand what that greater difference is they're trying to make. So the second conversation that an organisation's got to have now at the board level is, one is our purpose, but what would success look like if we were really good at that purpose? How do we know if we're going to actually achieve a change? And in the community sector, this is becoming a really hot topic around the words outcome rather than outputs. What is the outcome that you will see in your community that shows that your intervention or interaction in the community has been successful? And if we can, at a board level, get really clear about this, we start to really make some wise decisions. So the way we do that is we need to think about what is success for that purpose, but then also think about the principles by which we will enact that purpose. So are we going to do it regardless of other people? Are we always going to make sure, for example, that we'll consider biculturalism, that we'll consider our obligations to the treaty? Will we do it by making sure that we have consulted the community, or will we feel like we know best and tell the community what they need? Will we work in partnership with other organisations, or will we try and be the organisation that dominates in the sector? A lot of these key principles of how we're going to get to the organisation's success picture is a really big conversation for a board to have. Remember, if you don't have these conversations at a board level, then everybody tends to use their own principles or their own belief of what success and the way to get there is. The other big conversation that boards really have to get focused on is, if you know the success picture, how will you be able to measure it? Will you be able to see clearly what that looks like? And will you have indicators that will show your progress along the way? Now, for many community organisations, measuring outcomes is pretty hard. So, for example, in Canteen, we have a real ambition to make sure that young people who are impacted by cancer actually have well-being and they don't feel defined by cancer. They can have a rich, meaningful future. But how do you measure that? How do you measure an increase of well-being from what we at Canteen do? It could just be that they have decided to be more positive. Was it our intervention that actually made the difference? So we have to be really quite purposeful in our conversations around what are the measures and indicators that will tell us that we are achieving success and it is due to the work that we are doing. Now, on a board, we often tend to think, well, if we're going to try and be successful and we're going to try and get success in our impact, what we need to do is go and find a great CEO or manager who will lead this for us. And that's true. We do want to have really effective management. But as a board, we have an enormous value that we have to give as well by having a diverse group of people around the table so that we can be a think tank for the organisation, so that we can get out there and look at what's happening in our sectors. We can look at all of the information that we tend to look at, like the news, the readings that we do, and we need to bring those information and perspectives back to the organisation. And in our board meetings, be a think tank and think, what's going on? What are we seeing in other organisations that we might notice that we have to think about for us? So, for example, Waikato DHB is having a very unpleasant week. They've got their digital interruption, their cyber attack, and that whole organisation is in major crisis mode. I happened to be working in Hamilton on Monday and was with someone who got the call at 7:30 in the morning to say, hey, we've been cyber attacked. Now, that, while they are trying to work out how that happened and why that happened, their board has to be a think tank now. How do we make sure that we don't let this happen again? And the rest of us and every other organisation around the country, we should be learning from what's happening with Waikato's DHB. And we should be going to our next board meeting and going, how are we protecting ourselves against cyber attack? Are we ready for something to go wrong? So our job as a board is to make sure that we are thinking about what is going on in the future and bring all of those perspectives and ideas that we have from our own work life and bring them for the benefit of the organisation. The other piece that we have to be very careful about when we're working as a board is to have a nimble attitude. We can't get stuck that we should just be doing the same things the same way. As we got all very powerfully reminded last year, with COVID-19, if you just try and do the same things, you are going to get left behind, or you may well find out that your organisation just isn't fit for purpose. So developing a nimble attitude, this is our key, so that we as a board we have a strategy, but we are ready to adapt it and make it more purposeful depending on what opportunities and risks are in front of us. Next slide, please. So, what are some of the important developments that are on the horizon that boards should be talking about? As I mentioned, we've now got EESG, employees, environment, social and governance factors. You need to be looking outside your organisation and noticing what is going on. Social media particularly are asking us to make sure that we make wise decisions around our impact in the world, and that's on all facets. Are we being wise in the community? Have we got an appropriate environmental footprint? Are we socially responsive? We also have to think about those rapidly emerging technologies, and particularly how we can take these up without fear. So a lot of people worry about technologies making sure that jobs go off. But in fact, history shows us that technology usually creates jobs more than it takes away jobs. So I was hearing an example the other day about a most effective health and safety response for window washers of large tower buildings now is to get away from using people to do the window washing, because drones actually window wash office buildings far more effectively than people do. And when you consider the health and safety risk of having people hovering on lines from a tower block, maybe we should be thinking about using drones. We need to also be realising that here in New Zealand, we have a skills shortage and it's just going to get worse. So we have traditionally relied on importing talent into New Zealand. We haven't had a lot of talent coming in because of our closed borders, but we've also got an education system that hasn't really kept up on keeping our skills appropriate for what our businesses need and our organisations. So skills shortage is one of the biggest risks we have. How do we find the right people with the right skills for the work that we do? So many boards are starting to think about how can they support or partner with other organisations to try and get around this skills shortage. You might not be feeling the impact of this lately if you haven't changed anybody, but watch what happens when you try and advertise at the moment. It is pretty hard to find the right people with the right skills. There's also a whole lot of new look partnership models on the horizon. So because all organisations, including profit organisations, are focusing on EESG, they are looking to partner with government, community and profit organisations working together to get some really good outcomes. So there's some real opportunities out there, particularly for community organisations to do that. But please remember that you've got to have a really good brand before an organisation will want to hang out with you. As I mentioned, biculturalism, this is the hot topic, and it's also one of the biggest assets that we have in New Zealand. A lot of Maori organisations and Maori governance have some very effective ways for us to look forward and think about how can we work. There are demographic changes. We have just about to tip over and have more people retiring than entering the workforce. That's going to be a big challenge for us. We've also got people really pushing hard for equity, and the government is certainly feeling that pressure at the moment with endless asks on what they should be doing. And then I don't want to even mention climate change. Next slide, please. So what does this mean for you as a board? You've got to be thinking about all of those risks. And the way you think about those risks is not to jump down, get inside the organisation and start tinkering with it. Keep your distance at a board level. So that means keeping your height and not panicking and trying to take over from management. If you keep your height, you'll start to notice the key risks. The best way to do this is to get your management to ask, what are our 5 biggest risks that are on the horizon? Get around that board table and talk about what your 5 biggest risks are. That's a great way to handle your health and safety. Do you understand what your 5 critical health and safety risks are? Or are you just getting a report on incidents? Make sure you hear from a range of people. Get a diverse group around your table, but also get out there and talk to other stakeholders. Get out and walk around and talk to your staff. Find out what their concerns are, what their ideas are, and then you can find out how to manage them. Learn from other organisations. Watch what's happening in the media. Watch what other organisations that you partner with are going through, and then bring that question back to your organisation and say, what do we do about this? Have we thought about it, and are we ready? And please, don't just talk about it. Do something about it with a good, clear plan. We saw this very effectively with Christchurch organisations last year. They were not that impacted by COVID-19 because they've been through a crisis and they've learned to create plans. So this is your strategy now, is create plans. And remember, hope is not a strategy. You can't cross your fingers and hope that this won't be a problem. You have to actually take action and lead from the front. So I wish you well in your strategic leadership, because actually that is where the fun conversations happen, not just checking the financials. So good luck on your strategy.
Look, that's awesome, Carol. So much to think about, and I've got about 3 or 4 questions in my head to come back to you on. But what we're going to do is, if other people have got thoughts or questions, park those. And also, it does link quite well into Bernadette. You talked about impact and outcomes, and so hold that thought, everyone. Bernadette's going to take that a little bit farther from Impact Lab, but we're going to take a slight left turn for a minute before we go there. Again, when we're thinking about this webinar, the 3 topics were, that effective leadership at the board level that Carol's just talked about, impact, which we'll come on to, but also in terms of investments and investment strategy, the current environment, low interest rate. It's a very common conversation we're having with people. So that's where I thought we'd invite Andrew Austin, who's a wealth management advisor with Jarden, to come along and talk to us for a few minutes. Andrew's a good friend of the firm, works a lot in the not-for-profit sector, so has a lot of experience talking to boards and answering boards' questions around, how they manage their investments and, what is appropriate for the type of organisation that they are. So, Andrew, it's good to have you here. Welcome, and look forward to hearing what you've got to say.
Right, thank you very much, Henry, and also thank you, Carol, for a very, very professional start to the morning. I hope I can keep that up. So yes, look, as Henry mentioned, we work a lot with in the not-for-profit sector. So today is really about observations that we're hearing from our clients, the conversations that we're having out there. It's pretty non-specific because, as our disclaimer we've got up there, as says, every recommendation shouldn't be taken from this presentation. Everyone's situation is different, so it is important to make that point. But if we go to the next slide, really what I wanted to do is talk about the environment we're in, and we're all living it, we all know it, but let's set the scene. I mean, we are sitting in a lower interest rate environment, have been even before COVID we were, but particularly since COVID, we're sitting with an OCR rate of just 0.25%. We're in a stimulatory environment, if we can put it that way, where the Reserve Bank and the government is looking to really stimulate employment and economic activity. So we're doing that through the OCR. We've got on there, you'll see the LSAP, which is the large scale asset purchase program, which is up to $100 billion. It's another tool to allow the Reserve Bank to help the Reserve Bank lower rates. But interestingly, we've got inflation there at 1.5%. And if we can move to the next slide there, we can talk about that a bit more, but will this low interest rate environment continue? There is a wide dispersion of views on this currently. Even if you look at the major banks and economists, ANZ's sort of saying maybe August 2022, so next year, whereas Westpac's, I think last I saw, was still talking 2025. So there really is a lot of uncertainty remaining. But what we have seen this year, which has been quite interesting, is is we have started to see longer term rates go up. And I use the example on the slide there of the government 10-year rates, which start of the year were about 1.1%, still very low, I know, when you look at 10 years, but they did go up to almost 2%, but currently around about 1.9%, which is quite a dramatic rise in the start of the year. And why did that happen? Well, global economic activity has improved. We're seeing vaccines roll out. That chart there shows sort of UK leading the way there. And that is allowing economies to get started again and open up a bit. So what it is raising expectations of inflation to continue to rise. And inflation is a key determinant on interest rates. So if we can move to the next slide there. Sorry, the first few slides I'll race through a little bit to keep us moving. Because we do need to remember that inflation is what we need to watch. It is a key determinant of interest rates. Because as inflation rises, it's a key tool to lower inflation is using interest rates. So it's interesting what we're seeing at the moment. In the US, the last read in April was we had an inflation rate of 4.2%, which was quite high and exceeded market expectations. Compare that again to New Zealand being at 1.5%, although we've got that reading to come up very soon. And there's some interesting themes playing out there because, you know, you could instantly say, well, inflation is very high, let's raise interest rates, but it's not the case yet. What we're seeing is more some short-term, and I use the word transitory, themes going on there. I mean, global shipping congestion is a big one. We're starting to see it here with building supplies, harder to come by, so prices are rising in that area. We're also seeing unused areas of the economy, if I can put it that way, so sort of airlines, hospitality, hotels, even used car sales are really starting to spike up because, again, economies are opening, and used car sales are a good example. In the US, it was up 10% in terms of prices. So what we're seeing is perhaps a short-term rise in inflation. I've used the word head fake, or the term head fake there, because what the Reserve Banks are telling us is that they believe it's transitory. So it is short-term. So they're not going to race to raise rates immediately, and that's what they're telling the market. Probably a good point to move on to the next slide there. I guess the point really is that yes, rates are continuing to be low, but we're starting to see that tension of inflation coming through. The conversation is becoming louder, if you like. So where to from here? I mean, our next announcement is on the 26th of May. We're not expecting any change, and no one in the market is. However, chances are increasing that perhaps the outlook is signalling an earlier rate rise than it has been previously indicated. You know, a consensus view might have been that we're looking at 2023, and it may now be that we're looking at late 2022. But we do need to take this in context. We are at record or historical lows. So even a rate rise in late 2022 will take us up to 0.5%. We're still at a very low point. And it will take time to get back to, I mean, it was September 2016, I believe it was, when we were last at sort of 2% OCR. So it's going to take a bit of time to get to normalisation, if you like. So that was my setting the scene. If we go to the next slide, please, Christina. Where we're having a lot of conversations at the moment is, you know, the not-for-profits or PBEs that are in the unique or privileged situation of having investments, and we know not everyone is. Real or inflation-adjusted returns are very, very challenging. If you compare inflation, as I mentioned, 1.5% to the current cash and term deposit rates, and we all see these, real returns, actually, we're getting negative returns if you're sitting in term deposits, particularly if you're spending the interest that you're earning off that. What we're noting is that there's a real realisation that there is no such thing as a risk-free asset in the current environment, and it's pointed that cash and term deposits are not risk-free. And what I mean by that is that term deposits do have a risk of interest rate or inflationary risk, and we're experiencing that now, that if you're holding cash and term deposits, you're actually making negative real returns. So where do you invest? And this is where we put a disclaimer on that you do have to be very every organisation will have unique needs to explore that. But cash and term deposits, as I mentioned, are pretty much negative returns at the moment. Corporate bonds is similar, but you can look to get, if you're looking at lower credit quality bonds, you're starting to get 2.5%, maybe even up to 3%. So you can sort of generate some real returns there. Again, there's a slightly higher risk. So equities is what we're getting talked about, and property, and I'll get to that a lot at the moment, because the dividend yields, particularly in New Zealand, still 3 to 5%, reasonably attractive, even after all the returns we've been, or the height we're seeing markets at these days. So equities were still providing good returns, and unique with equities, of course, is these are companies who are generating earnings, so they have a natural tendency to be able to outpace inflation if you're in the right companies. Property, still reasonable, and I'm probably, I am referring to listed property here. So on the share market, mainly commercial property, the yields again, or income you're getting is 3 to 5%. Capital gains getting a bit harder. So cash and term deposits, not really a good place to be, but they have their purpose. So we'll talk to that in a minute if I can get you to move on to the next one there. Thanks, Christina. So what broadly we observe with not-for-profits is, if you've got investments, it's generally two strategies. It's either you're holding cash and term deposits, or you've put in place a diversified portfolio, which may include equities, property, bonds, and your cash and term deposits. So I'll address both of those really, of what you can perhaps look to do. And if you're in a term deposit strategy, as we've mentioned, negative real returns at the moment, it is challenging. So the question you've got to ask, is it appropriate to diversify into asset classes that are providing higher returns? And that is a big question. It's a big maybe. Every organisation will be different, but what I'm suggesting is, at the moment, is a very good catalyst for starting that conversation if you haven't. Because as I mentioned, we've realised that term deposits are not risk-free, so diversification is an investment fundamental. So perhaps now is the time to start that conversation with your board, your committees, your senior management. What are the purpose of these funds from the long term? Can we look to take on some equity market risk, and look to diversify the strategy? So it's not too late to have that conversation, but there is a very good use for term deposits and cash if you need those funds in the short term. But if it's long term, good time to start that conversation. May or may not be appropriate, but that'll be what I'd say. Use it as a catalyst to have that conversation. Moving on, if you are, the common question we're having from clients is if you are already in a diversified strategy, so let's say you do own some shares, a common question still is well, should I buy more shares? Should we buy more shares? We're not getting any returns on the term deposits and perhaps even the bond element of our portfolios. Yes, if I could get you move on to that next slide. Thank you. So it's similar, it's saying, well, should I actually buy more shares? And it's a similar question, and maybe we need to use this as a catalyst to talk to your board and address, well, what are the purpose of these funds? Are we too low risk? Because it is becoming apparent that even a low risk portfolio, and maybe 30% is in growth assets, is probably just or struggling to keep up with inflation. So these questions are quite rightly being asked. So we can't give you the answers here, but it is about, right, is this time to have that conversation again and really figure out what the purpose of these funds are? Because if you take on more growth, then perhaps it can grow your organisation over the longer term, but stakeholders need to be aware that the more you have in the equity markets, the more volatile your returns are. So each quarter or reporting cycle, you're going to see potentially negative returns in some reports. So it's about having that conversation. But my point today really is use the current environment as a catalyst to start those conversations. Probably good point to move on there. Thank you. Keeping an eye on the clock there. So the challenges that we're seeing, and we've touched on a couple of them already, is generating real returns. So we've talked about that. It is the biggest topic of conversation. We know how much not-for-profits rely on their investments, a lot for income or a lot to meet their future objectives. So in a low return environment, it is very, very challenging. Income needs, we've somewhat touched on that in saying that if you are relying on the income from your investments, clearly it's become very challenging, and conversations around, do you need to have some dividend paying equities in your portfolio? And again, it's a conversation you've got to have. It's got to go through due consideration before you can immediately decide that, but it is an option. One that I'm finding really interesting is, and I'll put it in brackets, the perceived need to be inherently low risk as a not-for-profit. And I understand that. And what I mean by that is that boards, if they're lucky to have investments in their financials, not-for-profits do see themselves as needing to really protect those. And I understand that. They've got to be low risk. They've got to protect those assets. However, it comes back to what I mentioned earlier about no asset being risk-free. So what we're seeing as a real challenge is boards and committees really needing to understand develop their understanding of risk. And it's a real challenge because it's not always investment experience that is firstly sought after to be on a board or a committee. And that'll probably take me to the next slide. Just to continue that, if I could, Christina, is the challenge of investment management these days is much more complex. 10 years ago, or 12 years ago, whatever it was, when you could simply hold cash and term deposits and get 6-7%, the management was much easier. These days, you do need to generate real returns. You do need to have multiple asset classes, and the fundamental of diversification that brings with it complexity. You need to develop investment policies. We use the term SIPOs, the Statement of Investment Policies. You need to develop those. You need to maintain those. And the next point there, I've touched on it, volatility. Even though equities you'd expect over the longer term to provide much better returns, they come with volatility. So are the boards comfortable with, and stakeholders understanding that, not every quarter is going to be a positive, whereas at least with term deposits, you see a reasonably stable return and value. So that's a real challenge for some boards who are transitioning from, if you like, from term deposits to perhaps a more diversified strategy. Now, I'm just keeping an eye on time and probably finishing well there, but I'll come back to it again. We noticed that investment experience is a tricky one to fill on boards. The not-for-profits have very objectives of filling that social need, and investment experience is not the first thing that becomes on a resume or sought after on a resume. So just highlighting that it is something to include there and look for that experience on your, and I've used the term board. Or you do need to seek some external advice, because it is a very important area. If you can grow your investments within your organisation, longer term you can grow the capabilities. So we see it as a very, very important area. But that's probably a point I can finish up there, Henry.
Great, thank you very much, Andrew. Brilliantly done on time. Well done. Look, as always, like Carol, so much to think about and so many great questions for boards to ask themselves. I've jotted down a couple. Ultimately, it's hard. The environment's changed and it's hard, right? So we'll come back to that. I'm thinking the importance of getting good advice and people to help you through that to make that right decision is really critical. So I think really great questions for people to take away and ask their boards and work through with their boards. The concept that, even cash is not a risk-free investment because you're basically going backwards is a really good point to take on board. It's a real challenge. Don't know the right answer, but you've got to work through it. So thank you, Andrew. That's great. Now, for those of you who are observant, you'll notice that I've got Bernadette alongside me here. So Bernadette, she works for the Impact Lab, and if you haven't heard of Impact Lab, or you don't know about the Impact Lab, and in the next 15 minutes you'll find out a lot about what they do. They do some awesome stuff. It's I'm going to explain it in 10 seconds, and then Bernadette will do a great job in terms of taking data for not-for-profits and determining really what the social return on investment is, that and using data and really having a great methodology. We talk about impact a lot. From an auditor's point of view, charities are now required to do statements of service performance and determine how they measure things and that sort of thing. So hopefully I know over the next 15 minutes or so you'll learn a lot more about what Impact Lab do and how, again, you can ask your organisation some great questions about how you do go about measuring your impact, which again links to what Carol started. So thanks very much for being here, Bernadette, and again, we're looking forward to what you've got to say. I'll move out of the way and leave it to you. Yeah.
Awesome, thank you so much, Henry. So as Henry mentioned, my name is Bernadette Scanlon and I'm the Strategic Projects Lead here at Impact Lab. So today we want to just cover off a few points, a bit of information about who we are and what we do, and the problem that we're really trying to solve, what we mean by measuring impact, how this links to decision making, and a few comments on the statement of service performance. So we were, if we just switch on to the next slide, awesome. So who are we? Well, we were founded in 2019 by Sir Bill English and Emily Mason, who really do have a wealth of public sector knowledge. Coupled with philanthropist Fran Wyburn, our founders saw that there was a gap in the market between investors who are wanting to invest in doing good and the not-for-profits and charities who are on the front line of doing this good. Thus, they created Impact Lab to effectively help bridge that gap. So what our founders were observing was that from a funder's perspective, they were wanting to know more about their investments beyond what was currently being provided. They wanted to understand the impact their dollars was achieving for the communities that they really cared about, and were wanting to make more informed investment choices. From the not-for-profit and charities ends, they were wanting to better communicate their impact stories, especially to funders who are often financially savvy, who understand concepts such as return on investment or cost-benefit analyses. So they wanted to ensure that they were speaking the same language as funders. Also, they really wanted to access sustainable funding streams so they could focus on doing the good that they are doing and rather than being distracted by fundraising. And finally, they also wanted to understand more about the effectiveness of their service delivery models and ways to improve this. So one way of doing this, and as Carol mentioned, a quite useful way as well, is to start measuring impact. So I was really excited listening to Carol's session because she was saying it is hard, and that's exactly what our founders also found, that there are some barriers to measuring impact. First and foremost, unlike that of the accounting world, where there are accounting standards, there is currently no standardized measurement framework for which investors, funders, communities could actually measure their impact. Thus, measurement was often difficult and also largely inconsistent. The information that was currently being provided was often confusing as well, either with too much information or too little, and a lot of it just qualitative in nature. People were finding measuring impact either expensive and time-consuming, and a little bit ineffectual, as it didn't include linkages to how you could actually improve your service delivery model. So our full aim is to create a world where investment works for communities, and want to do so by connecting decision makers, both from the funders and the service providers ends, with information they can act on to grow their social impact. We do so by doing kind of three main steps. The first is to create a baseline, so that's doing the measurement aspect and calculating the social return on investment. The second step is really to provide insight as to how you can improve the impact that you're creating. And the third is to re-quantify, to work out, did that improvement actually occur? And if not, how do we iterate? So what do we actually mean by measuring impact? So it's all kind of focused on this concept of social value. And how we define social value is the social impact in dollar terms that a program achieves for its participants over a lifetime. We work with not-for-profits and NGOs to kind of understand your service delivery model and calculate this thing that we call a theory of change or intervention logic model, which in reality is basically understanding how your services and the services you're performing to people achieve certain outcomes. We define an outcome as a positive change in state. So this could be a good thing, so an enhancement of, say, increased income, or it could be an avoidance of a cost, so avoiding Ministry of Health costs or avoiding a health challenge. We work with the social service providers to kind of understand how their participants' trajectory, what it would have been had they not obtained the program support, and what it would have been, what it is post obtaining the program support. So it's really that difference in the trajectory, which is what we define as being that social value. So next slide, thanks. So our actual calculation has 4 key components. The first is impact, which is the monetary value placed on a change in state. From this, we use information obtained either from the IDI, or we do an econometrics assessment based on really good publicly available data. We work with providers to understand their service model, which we will assess the effectiveness of against what global evidence and literature states as being best practice. We then ask ourselves, what was the opportunity, this program's opportunity to make a change? And this factors in things such as a counterfactual, and really asks, how targeted is your program? And finally, because people are at the heart of our calculation, and it is a bottom-up approach in which we attach impacts to people, we really need to know how many people are in your program, and not just the people who started, but those who successfully completed. So far we have measured 80 programs, which tallies up to approximately $115 million of investment. And the more exciting figure is that that's kind of impacting 6% of New Zealand's population. We've covered sectors such as youth development, family, arts, sports, anything really that's involving changing the lives of people, especially at the harder end of the scale. So that's how we calculate and do that kind of first step as to what is your social return on investment. So we provide a narrative as to what your theory of change is, as well as a figure which basically says, for every dollar you invest, this is how much good you produce. If we just pop to the next slide. This can be really beneficial, as obviously it can help with obtaining further funding streams. But it also, one of the things we've noticed is by doing the actual process, it's been really great in reinvigorating staff, getting an external organisation just to come in and to help them validate the good that they are doing. The second step, though, is kind of what information, what things do you want to be thinking about to improve your social impact? And this is the stuff that I get really excited about, especially because I'm more the consultant in this team. So some of the key factors to improve social impact is, first and foremost, obtain better data. So obtaining information about your participants in terms of their demographics, their risk profiles, the vulnerabilities that they presented prior to entering your program. Obtaining information about how effective your program is. So for example, if you're doing a program in relation to trying to get people into employment, post that program, are you doing a survey or following up on them to understand, did they obtain employment? And if so, for how long and what type of jobs? Because we provide information about what global literature states as being best practice, this can be also used to help improve the service design going forward. Part of the process of calculating the social return on investment is understanding how much was invested or how much was spent to actually achieve those outcomes. So this requires a little bit of different thinking potentially for some of our programs, which is connecting the costs or the inputs to the outputs, which is really akin to that of management accounting. This is exciting because it can be used in many other informative ways. And once you know how you're spending, you can alter your spending decisions. We're asking the programs that we're working with to really consider what successful completion looks like. So what that means is getting them to think about what part of my program and how much do they need, what do participants need to do in order to reap the benefits that we're seeking to achieve. And finally, a way to improve your social impact is just to consider who you are supporting. If I'm a universal program, do I want to do some form of risk assessment or initial screening to become more targeted? So when I first started the presentation, I mentioned this gap between funders and not-for-profits. And one of the other barriers for not having kind of the standardized framework was that there was no mandatory requirements necessitating the measurement of outcomes. There is, however, as Henry mentioned at the very start, the Statement of Service Performance. So this statement isn't new, it's been around since 2015 if you're a Tier 3 and Tier 4 charity, but as of the 1st of January next year, Tier 1 and Tier 2s will also need to comply with this for completion of the standard. So the key objective here is to establish principles and requirements for an entity to present service performance information that is useful for accountability and decision-making purposes in general purpose financial reports. So this is a big recognition that public benefit entities are very different for-profit entities. They have different objectives, and the users really want to know what you're achieving and how you are changing people's lives. So there's two key mandatory requirements. Just jump to the next slide of the standard. The first is to provide users with sufficient contextual information to understand why the entity exists, what it intends to achieve in broad terms over the medium to long term, and how it goes about doing this. So this is really kind of like drawing from that kind of foundational documentation, strategy information. It really lends itself towards the vision and mission. The second component, or the second mandatory requirement, is to provide users with information about what the entity has done during this reporting year to work towards its broader aims and its objectives. So our thoughts on this standard, the statement, is that it is a good start. If we just jump to the next slide. However, it is very flexible and non-prescriptive as to what can be included. There is a lot of could have, may do, and it can include quantitative measures, qualitative descriptions, but no requirements to include any or all of these types of information. So whilst we do think it is a good start and it's heading towards the right direction, we would argue it doesn't go far enough. It doesn't address some of those initial problems regarding the gap between funders and providers who are demanding more information about what is actually happening with organisations and are we achieving the success we need to do. It is largely inconsistent and doesn't really necessitate the quantification of outcomes. So my final words would be that we think the bar can be raised higher for funders and providers. We want funders, charities, not-for-profits, we want you to be asking yourself, what are the things we need to know about the impact we're creating? How do we know we're making an impact? What do we not know about our impact? Are we reaching those people who have the highest risks? Is our approach to service delivery right? And how can we iterate it? Is our cost base efficient, especially compared with others? And how can we maximize our social impact both now and in the future?
Scoot back in there.
Yeah.
Again, brilliant. And I love the way you left us with a lot of questions. I'm not going to try and answer those now, but again, the point is for everyone listening that to work your way through some of those questions, like all three presenters, is a really good way to start or keep your thinking moving on this. And I acknowledge that the statement of service performance is not perfect, step in the right direction. And there's a difference between entities who see it as just as a compliant exercise to do it, and others who see it as a stepping stone to inform and moving, and a lot do that, and so I think it will improve over time, sort of thing. Hey, great, thanks very much, presenter. You've all done a great job. I gave you a really tough job of trying to cover three massive topics in a short amount of time, and you've done a really great job of summarising that, so thank you. I'm going to hand over to Matt. So we've got about 10 minutes now just for some questions. I've got 2 or 3 questions myself, but I think, Matt, I'll hand over to you in terms of other questions that have come from the audience. If you want to raise any questions from the audience, either to be answered now or thoughts or questions that you've got for the panel to come back to you on, and I've asked them all, and they're very happy to come back to you individually after the end of the webinar if we don't have time to answer that. These guys have a huge wealth of knowledge, and so part of the idea of this webinar is to slightly introduce you to them, and so you can tap into that wealth and that sort of thing. So Matt, I'll hand over to you to sort of run next sort of 6-7 minutes in terms of questions and conversation.
Thanks, Henry, and I'll just reiterate great stuff from each of the presenters. Really interesting stuff. I think the most pleasing thing to come out of that was the link in terms of each of your presentations. So Carol starting off with governance and all the themes that came through, linking through to impact, and obviously also linking with Andrew's points around investments and risk, and always looking forward onto that horizon, what's coming up, what do you need to be dealing with. So a couple of questions that we've had come through. Carol, there's been a couple of comments there just wanting clarification around EESG. So do you mind just reiterating what that stands for?
Okay, and thanks, Matt. EESG is essentially the theme across the world to make sure that organisations think outside their doorway. And so the new E, employees, is basically when you're making decisions at a governance level and you're thinking about your organisation, you really need to think about the impact on your employees. So a lot of, for example, profit organisations are now starting to think about, actually, we have to make sure that we're not using child labour in our supply chains. In the not-for-profit world, we're starting to think about how do we make sure that our employees are being looked after. It's very common in the not-for-profit world to overwork our people because we can't pay them that much. And so it's really common, for example, to employ someone for 15 hours and expect a full-time performance. So it's about boards recognising we need to think about our employees. You need to think about the other E, which is your environmental impact, and make smarter decisions around how do you actually impact on the world and the environment. The social is how do you actually impact on the social well-being of the people around you. So that's about thinking, are we targeting our services in the right way? Are we working with these people in the way in which they expect to be worked with? Or are we coming in and telling them what we want? And the governance piece is recognising that there's a much bigger picture that we should be looking at right across the country around linking government policy with our governance decisions at board level and making sure that we actually think big picture rather than just reactively. So EESG is trying to make people think bigger.
Great, thanks, Carol. That's a perfect explanation. There's a recording of this that'll be available, so if you need to go back and get a snapshot of that, that was perfect. Just a question, I'll kick off asking it to you, Andrew, is a question around managing risk, and if you're lucky enough to have funds available to invest, is there any rules of thumb around the amount that you need to have readily accessible versus the amount you can lock away, if you like, for those long-term gains?
No is probably the answer, because each organisation's unique. But what I could say is time horizon's the key thing. So it's being able to identify which portion of your funds you don't need for, let's say, 5, 7, maybe 10 years. It's probably more about separating short-term needs with long-term needs, because if it's long-term needs, that's when you can start to explore other asset classes, and that's what I referred to, I guess, of cash and term deposits for your short-term. But it would be, to answer your question, each organisation should be unique, but it's about answering that question: what's long, what's short, and coming up with a percentage or a number based on that.
Thanks, Andrew. And I think I'm also on the canteen board with Carol, and it's something we're doing right at this moment, making that decision between what funds need to be accessible in the short to medium term and what are we comfortable with putting away in the longer term. And you're right, Andrew, there's no template answer to that, but hopefully if your board is having those right discussions around strategy and future focus, then some of that will naturally come out, and you'll start to find what's right for you. I'm just going to jump back to, this really relates to both Bernadette and Carol. So there's some the question actually was to Carol around canteen being a good example of something that's hard to measure in terms of its goals, and so what are examples of how the board might track impact or outcome? So Carol, maybe if you've got just really quickly 1 or 2 examples that Bernadette could maybe pick up on there in terms of how that could be fleshed out.
Yeah, and it is definitely a work in progress. Essentially, what we are doing is we are doing a wellbeing scale with young people when we first interact with them. So how do they self-rate on 1 to 10 on their own wellbeing? And then after each piece of our interaction with them, what then changes in that self-assessed 1 to 10 scale? So that can be a quick, easy way where you can actually measure progress through the eyes of the young person. So Bernadette, have you got comment on that?
Yeah. So that's a great way to put like some proxies to indicate where you're heading towards, and ultimately we'll just suggest that you get it measured. So going through something like coming to our organisation, whereby we will understand what the risk profiles are with those individuals, trying to understand their trajectory, and then use external information to determine what those outcomes are, which is again the avoided cost that is associated with that program, as well as the intended benefits.
Yeah. The other thing that we tend to do is look a lot at referrals, about how many young people refer other young people they know, because they feel like the canteen experience has been something useful to their lives.
Thanks, that's great. So we're just coming towards the end of our time, so there's a lot more questions I could ask, but as Henry mentioned earlier, you can see our contact details there, and I'm sure our presenters will be more than happy to deal with any questions offline as well, if you want to send those through to us. One question that's just come up is a clarification around when the statement of service performance has to be implemented for those tier 1 and tier 2 charities, the larger charities. So some of you might recall last year this was pushed out a year due to COVID. So the first organisations to have to present that in their financial statements will be 31 December 2022 balance dates, but they'll have to present the December 2021 information as well. So if you like, 1 January this year was the beginning of the very earliest measurement period that you'll need to be thinking about. And I think just touching back a little bit about what Carol was talking about, and also Bernadette, is our early engagement with clients around statement of service performance. I think they've all found it really beneficial, and we've really enjoyed it as well, because you're actually having a discussion around what the organisation is truly there to do. And I think that, although Bernadette, you're right, the standard's quite general, it's not that prescriptive, but I think once organisations get into it, they're finding a really good link there between a kind of 3-level approach. So you've got your overall purpose of your organisation at the top, which naturally, as Carol said, you really need to know and have nailed down. Then you get down to your more medium-term strategies. So again, board-led, board-set strategies. And then when you get down to the detailed metrics, that's something really that your CEO should be leading, driven off what the board has determined are those key goals. And that really is the layout the statement of service performance is talking about. So really do try and link that back. It shouldn't be something that's entirely new or entirely separate. It really should be board driven, and then leading towards that impact which funders really want to know about your organisation, and see it as something that's really going to benefit you going forward. And on that note, I'd better hand back to Henry, because we are out of time.
Great, thank you very much, Matt. Yeah, and a good summary of the performance reporting information. That is a huge topic of conversation amongst all. I wanted to ask Carol a question about how she does what she talked about, how you create alignment and clarity, but that is a bigger challenge in its own right, and so we certainly haven't got time to answer that question now. Look, thanks everyone for attending. As I say, if you have got questions, please send them through and put your contact details, and these guys will be happy to answer them. Thanks very much to the panel. Thank you very much, Carol, up in Auckland, and Andrew around the corner in Wellington, and Bernadette sitting next to me. We really value your time and your input. We value value our relationship with you as a firm, and it's cool to tap into your knowledge and expertise in these areas that align with the things that we do, sort of thing. So thanks very much for everyone's time, and enjoy the day, and look forward to find out what the budget's got for us in store this afternoon. I'm sure there's some good BDO coverage of that this afternoon if you're interested in that kind of thing. So thanks very much, everyone. Have a great day.